Hello everyone and welcome back to my channel. This is Georgia Cannabis CPA Desiree Anderson. Now what I do on this channel is I look for stories in the headlines. I look for laws that have come down from our judicial system. I look for laws that have come down from Congress. And I also look for laws that have come down from the states. And I take that information and I let you know how that information is going to affect you as a cannabis business owner, how it affects you from a tax and from an accounting perspective. So sit back, relax, and enjoy the show. Hi everyone and welcome back to my channel. Okay, so today I'm going to be discussing a case that finalized in March of 2022. However, the case originated, or rather it was based on a tax return from 2012. Okay, so this tax return was filed in 2012. The notice of deficiency was sent to the taxpayer in 2018, which is about 6 years later. So keep in mind that just because you have not heard from the IRS based on a tax return that you filed maybe 2 or 3 years ago, doesn't mean they're not going to come for you at some point, because the IRS, as you can see, have nothing but resources and time, because they actually waited 6 years before they sent this particular taxpayer a notice of deficiency. And it wasn't until 18, 19, 20, about 4 years later, 2022, when everything pretty much came to a head. So I advise my clients, and I'm also advising you to do things right from the very beginning. Do not play IRS Russian roulette, hoping that they don't come for you, because they take their time. They're in no rush. Okay, that being said, what we're going to be talking about today is a case where a taxpayer took depreciation and also took something called bonus depreciation where they were not allowed. Now, if you have a regular business in the United States, you are allowed to take something that is called makers. And I don't want to go too far down the rabbit hole with this because it can get confusing. So I'm going to try to keep it as simple as possible. So basically, the IRS allows you to take a particular type of depreciation where you can depreciate an asset over time a lot quicker than you would if you were using something called straight line. So, and in addition to that, there's also something else that's called bonus depreciation, which allows you to take additional depreciation on top of on top of maker's depreciation. Let me put it that way. So this cannabis business did just that. So they are I think that they are producers, and they took excess depreciation, and the IRS basically denied it. So this particular story covers 280E, okay, which I'm quite sure everyone knows what 280E is about, but we'll talk about it in a moment. Something called 471, and then something called 263A. So here is how all of this comes together with this particular case. So let's start out by understanding exactly what happened. So in a notice of deficiency dated on July 3rd, 2018, respondent, in this case the respondent is the IRS, they determined that the petitioners, who are the taxpayers, had a deficiency of $376,000 and related penalties of $75,000. So what this means is that they owed additional taxes, and because they underreported how much they owed, they were also slapped with a penalty of $75,000. Now keep in mind, this is over a 6-year time period. So those penalties are accumulating over the entire 6 years. It's not like the IRS says, okay, we're going to put a break on this and then we'll start to hit you with penalties starting from when we sent you the deficiency, or from when this case was actually resolved. No, those penalties start from the year that you underreported through the time that the case ends, and moving forward if you don't pay the deficiency immediately. So in this case, they owed over $300,000, and they were hit with about a $75,000 $75,000 penalty. Okay, so in question was whether tax depreciation methods for inventory production assets can be used can be used under either Section 263A or Section 471 when Section 280E is applied. So here's what that means. So when they say when Section 280E applies, that means that if 280E is being applied to your business, and it is applied to all cannabis businesses because cannabis businesses are illegal on the federal level. And because because cannabis is illegal and considered a drug on the federal level, that means that you are not allowed to take any expenses. So where a normal business is able to deduct all of their office supplies, all of their regular supplies, all of their payroll, all of their rent, all of their repair and maintenance, because you are a cannabis business, 280E applies to you, and therefore you are not allowed to take any of these expenses, right? So 263A has to do with cost of goods sold. 471 also has to do with cost of goods sold. Now, because cost of goods sold is not considered a deduction, it's really considered a return of investment, cannabis businesses are allowed to deduct their cost of goods sold. So now the question is, let's scroll down a bit. So let's see what happens. So I'm going to read this block of these. Sorry, I'm going to read this block of sentences for you, and then I'm going to go back and sort of try to break down to let you know what exactly it means. Okay, so it says the businesses did not have audited financial statements, and I'll tell you why audited financial statements is important in this particular situation. So they didn't have audited financial statements for 2012, and for non-tax purposes, they were not required to maintain books and records or financial reports in accordance with GAAP. So audited financial records, GAAP, that all relates, and I'll break that down for you shortly. So GAAP is, it says in accordance to US generally accepted accounting principles, which is GAAP. Okay, all right, now let's go to this. In 2012, the businesses maintained their books and records and financial reports on a tax basis using QuickBooks. All right, so pay attention to audited financials, pay attention to GAAP, which is generally accepted accounting principles, and pay attention to keeping their books on a tax basis. And I'm going to explain to you how all that comes together. Okay, so it says the businesses computed their depreciation included in cost of goods sold for 2012 using the accelerated cost recovery method detailed in Section 168. So basically, the accelerated cost recovery method allows you to take excess depreciation on a yearly basis. So let's say, for example, and this is I'm just throwing something out just so you can understand what this means. Let's say you purchase an item and that item has a 10-year life, right? And let's assume that you are allowed to depreciate that particular item over 10 years and you spent $10,000. So what does that mean? That means that every single year you can depreciate $1,000, and then at the end of 10 years, you depreciate the final $1,000, and therefore you have then used up all your depreciation. Well, when you depreciate something on an accelerated cost recovery method, which is a tax method of depreciation, then you may be allowed to depreciate that asset over. I would say you can depreciate the asset rather than doing it on a straight line, which would be $1,000 a year. You can depreciate additional, which means, and I'm just throwing this out there, you can depreciate it for $2,000 every year. So rather than depreciating $1,000 every year over 10 years, you're depreciating it for at $2,000, and therefore you are taking more depreciation than you would have if you were doing it on a straight line basis. So that's what it means. So that is what accelerated cost recovery method means, okay? And all this is going to make sense in a moment. So it says the businesses used methods pursuant to Section 168 and K that did not conform with GAAP, but the recovery periods that they used did conform with GAAP. So the parties agreed that depreciation related to production assets is includable in inventory costs. Okay, so let's put all of this together. All right, so audited financials. The reason why they brought that up is because if a business or a company has audited financials, that automatically means that their financials are being presented in the form of GAAP. Okay, remember how they said that, remember the word GAAP was used, and I was saying I'll explain to you what that means. That means, so if your financials are audited, that means that automatically speaking, your financials are being presented in the form of GAAP. So they said that these particular taxpayers or this particular company maintained their financials on a tax basis and not on a GAAP basis. Okay, so in order for you to be able to, number one, take depreciation as part of cost of goods sold, so in addition to being able to take depreciation as part of cost of goods sold, there are also several other indirect costs that you can also include as part of cost of goods sold if you are a cannabis business. And what this does is it's minimizing your tax liability. But in order for you to be able to take these indirect costs, including depreciation, as part of cost of goods sold, you have to maintain your books on a GAAP basis. You cannot maintain your books on a tax basis. And this is the major problem that this taxpayer had. So in addition to them not maintaining their books on a GAAP basis, which automatically would prevent them from being able to take cost of goods sold, to include depreciation as part of cost of goods sold. But in addition to that, they also took the depreciation as part of cost of goods sold, and they took it on an accelerated basis. And they also took bonus depreciation. So even if you maintain your books on a GAAP basis, which is required for cannabis businesses, if you want to take additional costs and put them in cost of goods sold, additional indirect costs, and put them in cost of goods sold, even if you did do that, okay, you're allowed. So that's a check mark. You're allowed to do that. But even if you kept your books under GAAP, you are still not allowed to take bonus depreciation. These taxpayers, or this taxpayer, took bonus depreciation as part of cost of goods sold. And in addition to that, they used the accelerated cost recovery method for depreciation rather than the straight line method. So if you don't maintain your books under GAAP, you cannot take depreciation, period. Okay, you can take $0 in depreciation as an expense. If you maintain your books, you can take depreciation as cost of goods sold, but it has to be straight line, and it cannot be the accelerated cost recovery method. So they used the accelerated method, plus they took bonus depreciation. So that in and of itself is incorrect. So even if they used GAAP, they would have still been penalized for using the accelerated cost recovery method, and also for using the bonus depreciation, right? So that is where all of this comes from. So what is the moral to the story, and how does this relate to other cannabis businesses that are out there? Well, the moral to the story is that as a cannabis business, it is imperative that you maintain your financial statements in accordance to GAAP. Because if you maintain your financial statements in accordance to GAAP, then there are several other deductions that you can take, indirect expenses, that you can take as part of cost of goods sold, that you cannot take if you maintain your books on a tax basis. So and I'm just throwing out some numbers, just throwing it out. So let's assume that your total income for the year was $10 million, right? If it was $10 million and Now you have, you can't take regular expenses, so you are 100% dependent upon cost of goods sold to help you minimize your taxes, right? So if your revenue is 10 million and then your cost of goods sold is 5 million, that leaves taxable income of 5 million because you can't take anything else. So automatically you're going to be taxed on 5 million. Now this 5 million that you are taking as cost of goods sold, we are assuming that you did not maintain your books on a GAAP basis. So that means that that's all you get. Now, if you're one of those ones that maintained your books on a GAAP basis, then rather than your cost of goods sold being 5 million, your cost of goods sold might be 7 million. So now all of a sudden, you're being taxed on $3 million rather than being taxed on 5 million. So for a cannabis business, it is, and I'm repeating myself because this is really important, it is actually imperative that you maintain your books on a GAAP basis, so that way you can take you can take additional costs of goods sold, so you can minimize your taxes, because outside of that you're literally being taxed on your entire income. So that's pretty much what this story is telling you. And so what they try to argue, that they did things the proper way, but the IRS is saying no, you didn't do things the proper way. And quite frankly, they lost, right? They lost. So hopefully, based upon this information that I am sharing with you today, hopefully you will be one of those cannabis businesses that contacts your accountant and have a sit down, have a conversation, and talk about how your books are being maintained. Okay, so if you would like my help, I can definitely help either consult with you or can help guide you onto how to maintain your books on a GAAP basis. That being said, if you already have an accountant, I suggest you have a conversation with your accountant, or at the very least, speak to a CPA and have them advise you on how you can restructure how you maintain your books and go from keeping your books on a tax basis to keeping them on a GAAP basis. This way you can take advantage of all of the other costs of goods sold that are out there for you to take, but that you are leaving on the table. Okay, hopefully this was helpful, and don't forget to like this and also subscribe for more content just like this. Okay, thanks guys, see you next time.